to Connie Yoshimura and Lottie Michael's podcast, All Things Real Estate in the Great State of Alaska. Today we've got Mike James sitting in with us. Mike and I have been partners in the brokerage firm for
24 years.
24 fabulous years on my part.
Lovely.
Yeah. A month longer than he's been married. No stupid jokes about house. No, is that joke you always
Work wife,
Yeah.
real wife.
No one thinks that's funny, Mike.
You're a month longer.
Yeah.
You gotta be.
That's not funny. Anyway, on to what we want.
We're here to talk business.
Yeah.
Today we're going to talk about
Financing and how to do financing for commercial investments. And we're kind of focusing on small business. So that would be small medical office, a plumbing company, or dental office, or, shoe store, just a small business type financing. And when I say small, it could go up to 10 million. So, but not Fred Meyer's build.
No, and if you look at it's the mom and pops of the world that do about 80% of the business here in the United States. This is a target here that drives our economy.
Take that, Bezos. Never mind.
But it's our lifeblood.
Right. Exactly right. Okay, so Mike's had a experience with Wells Fargo for
NBA.
15.
NBA. I'm an NBA guy.
National Bank of Alaska. Then they sold to Wells Fargo, and then Mike left, and we started working together. But anyway, he's been in commercial finance for years. It called some time ago, but still, that's his background. So, Mike, start us off. What kind of financing is available in Alaska?
So right now we'll talk about somebody that's buying that's an owner-user. You have two types, an owner-user or an investor. Right now we'll talk about an owner-user. In an owner-user, there's a couple of flexible financing for them. You've got a couple different programs. The first off is just straight conventional financing. Typically that's based on a couple points over the 10-year T-bill, Wall Street Journal Prime, half point to a point over. Currently the Wall Street Journal Prime this week, it's end of the month of February 2026 here, and that's 6.75%. And then
so it would be 6.75, and then a point or two.
Yeah, and then that point is all on risk. A bank manages risk. When they are looking at a loan, it's the risk to the bank if this was ever go south.
So they look at the quality of the asset, the quality of the property you're looking to acquire, and then they look at the strength of the borrower, you. So, and they put all of that together, and that's how they decide what kind of risk is there, and therefore what kind of reward they must get.
And another thing to think about is like talking about the quality of the buyer. So, not all buyers are the same. She banks at a different bank that I bank at. And so when you work with the same people time and time again, they understand your business. They understand your idiosyncrasies and how you work. And then, so having that history with the bank goes a long way to how quickly, one, you can put a deal together. And then two, what the bank's risk is. When I've known you for 20 years and, it's a lady that has a plumbing business. Now she wants a bigger building because she needs to get more inventory for the warehouse. That person, I'm going to know on an intimate basis as they have lines of credit, as they've gone through and financed vehicles and things or inventory. So
I'd have your MasterCard, your credit cards there.
Lines.
That's all of that's very important to the lender.
And so that is a level of risk that is less than somebody else coming in off the street and meeting them for the first time. Now they'll still have to go pull the layers back on the deal, and they're going to have to look at your business, and they're going to want, when you walk in, you're going to need to bring 3 years of your tax returns with you. We're, again, February of 26 here. You probably don't have your taxes done yet, or you might even file for an extension. So for 2025, get your profit and loss statement together and have that brought in with the prior 3 years before that. And then as the bank starts to really kind of get down in the nitty gritty with your business, you already being a history of seeing what your accounts do, the kind of money you bring in and out, allows them to maybe give you a little bit better of an interest rate as they figure out the risk. Your typical loan, you're going to come in on a conventional loan, is going to be 20 to 25% down. The bank is going to want a loan to value is going to be 80 to 75% of the value of the property.
And now we're talking conventional.
Mm-hmm.
So and if you're not sure how to get started, what we usually do, typically we handle introductions to one or more lenders. so you can make a decision on who you want to move forward with. We kind of grease the skids so they know what we're looking at, a history of your business, and some background on you. So you're not walking in cold looking for a loan.
Almost like a concierge. Because because we're talking about financing, but it's doing inspections and finding out mechanical, engineering, structural. As we look at zoning and other things, you're bringing in a team of players, and financing is a part of that team. So
when you said you're bringing in, what he really means is we assemble that team. We assemble that team for you.
But coming through on the financing with that, you have a couple of options. Your down payment is going to dictate what you're going to be able to afford. There's, if on an owner finance situation, there's other programs out there besides conventional financing. The SBA offers a 7A and also a 504. The 7A has a fluctuating interest rate and work with working capital. The 504 really works with real estate, and they also do equipment too. So let's say you're buying a building and I'm going to put a restaurant in there. I'm going to have to spend a lot of money building out a kitchen, putting in a hood system, makeup air, ansel, drainage, grease trap, separator, all these things that you're going to have to go through and do. They can add that to the loan package. So that's what the SBA 504 does. And that one has a fixed rate. It'll go up to 25 years. Currently, that rate right now, they do it every month. Evergreen is a third-party conduit for the SBA, and they have a region that covers Alaska, Washington, Oregon, Montana, and Idaho, I believe. And so they have an office here. Ryan, who is here every day, he's somebody you can actually talk to if you have any questions about the program. But typically, when you are dealing with the 504, that goes through your bank. So whether you're First National Bank, Wells Fargo, Global, New Vision, these are the ones where they'll talk with you, figure out what's best for you, and they'll kind of fit you into that program. They'll go through and have two sets typically applications. They'll have to do one for the bank and then one for SBA. What's nice about Evergreen and the SBA 504 is it's a program that can reduce the down payment. It makes your ability to have a project that's larger versus if I only have the 25% down, I only have a smaller building to work with. The SBA, if 3 years is what they're going to want to see you within business, their down payment is typically 10 to 15% down. It depends on the type of the asset. If it deals with hospitality, restaurant, they're a little bit more conservative. They're going to want you to put 15% down. So when I come in and I have a $2 million building, I just have to put down $200,000 instead of 25% with conventional at $500,000. So it really makes a big difference.
So if you've got questions, give us a call. We can help walk you through that. Once we know what it is you're looking for and what your needs are and what you have to work with, then we can better kind of give you our opinion and give you some direction. So that we've talked about conventional, we talked about SBA, and then there's ADA.
Yep. So ADA is the Alaska Industrial Development Export Authority, and that's really the Alaska's version of the SBA, and it works with Alaska banks and financial institutions. What they do is they still require minimum 25% down, but their rates are running about 5.9% currently.
So that's lower than
the 6.75 plus whatever you're going to have with Wall Street.
Considerably lower. The trick is they don't loan on everything.
So they don't loan on everything, but they are one, and you have to jump through some hoops. But to get that kind of a rate, I had done a little bit of homework on a $3 million deal, 25% loan to value. 25% down, 75% loan to value. Your loan balance would be $2.25 million. 6 months ago, that rate was 6.4%. Today it's 5.9%. This is the last day of February 26 here.
Let's just say that again. 6 months ago, rates were higher because what we hear a lot right now is rates, everything's unaffordable, the interest rates. And I don't know residential. Mike doesn't know residential. But in commercial, that's not true. Commercial rates have gone down the last 6 months. So don't take that soundbite as gospel.
Well, so we've gone down 50 basis points. So 0.5%. And what that means really is at the end of the day, if that same loan in September, your annual debt service was $180,622.
Annual.
If you do this today, your annual debt service is $172,314. The difference is about 5%. You're saving 5% that you can go put shoes on the baby or go to Hawaii or invest it back in the inventory in your business. But it's the thing that
So rates are not prohibitive. Honestly, I remember refinancing to get 12 and 13%. So rates are not prohibitive. 6 months ago, they were considerably higher than they are now. So if you're thinking of doing something, I always say sooner is better than later. At least let's get together so you can start your homework and your research.
Yeah, and just kind of really understand what works best for you. The thing is, there's different programs out there. The Evergreen, SBA 504 Evergreen, they go through and they provide it's really a partnership with the bank. So the beauty of this program is they do 40%, the bank will do 50%, and I'll do 10% down payment. So 90% gets financed. I put 10% down, allows me to get into a larger deal. The beauty of the banks is they're in first position and they're very secure at 50% loan to value. Evergreen Business Capital comes in with the 40%, and that's the second position. Now, the loan is not all 5.8% currently, as it is the rate right now. It's only on the 40% that is stipulated to the SBA 504. The bank still has their interest rate, so they might be 6.75%.
It's a blended rate.
It's a blended rate.
Still very competitive. Still very, very competitive.
But it's better than 100, it's better, so instead of being 75%, I've got 90% financing, and I don't have it on the entire 100% of the loan. It's on 40% that I have that 5.8. You pay your monthly payment though over the years. You just write one check. The bank takes that and then they split it up. So you don't see it in the background, but they put their portion on this one side, and then they pay the Evergreen SBA for their portion each month. So you don't have to write two checks or anything.
So let's talk about ADA.
We go through, they split that payment in two. You have to know there's a prepayment penalty though, of the SBA, and that's the first 10 years of the loan. And it's a decreasing, it's a sliding scale on the penalty. I think it's like 10% of their balance, them 9. And so if you want to pay down principal and pay things off early, pay the bank's portion.
Yeah.
Typically, you're not going to have a prepayment penalty there. So pay off the bank's portion. And then after 10 years, if you chose to, you can start adding on the SBA. But remember, they're always going to have the lower interest rate of the two.
And the prepayment penalty is more of a defeasance. So depending on what interest rates are at the time you pay it off, that defeasance fee or penalty goes up or down a little bit. But it was for the first 5 years, but now it's 10 years.
And the reason why that's there is they don't own that note. They take my note, they take your note, they take that person's note and that person's note. They put them all together, truncate them, and sell them on Wall Street. So these investors are buying this rate of return. So if you pay it off early, it affects their rate of return. So that's why you see that prepayment penalty, the defeasance there. So it's not because they don't like you, it's because,
well, in your case, it is.
Somebody has to go through and pay the piper. If you have any questions, you can email us at podcast@bhsalaska.com. Send us whatever kind of on your mind.
Yep.
And we'll see, maybe we can write up another podcast for you on something.
We've
for different ideas. And we can go through and answer some questions on the next one.
Okay, we've got a couple of comments off of our webpage. So we're going to address those now.
Questions, answers, and comments of what we have for you.
Yeah, you had an acronym for that.
QAC.
QAC. Okay.
But no, we just want to say, as we get feedback from people, we appreciate it. One of the things that we have here is comments that we get feedback from people we appreciate is somebody wrote, people don't buy from a process. They buy from people they know. This is something that's important. Relationship driven is, it dives really into our business. It's referrals. It's how we treat people. That all takes care of itself.
And it's our track record. I mean, we've been doing this a good number of years, and we have a track record of honesty and success for our clients.
Yeah, and it's one where sometimes things are easy and sometimes things get very difficult, but it is where we appreciate the clients that respect our time and our efforts that we do, because at the end of the day, we always succeed when you succeed.
But that was written, someone sent that in. I thought that was pretty cool that someone took the time to just give us kind of a thank you and a heads up. And then we have kind of a question. I never thought about Alaska's commercial market as part of the global economy? Why would a mid-sized commercial investor consider investing in Alaska? That was the comment. So do you want to start with that?
Yeah. So as we have buyers here in Alaska, we have buyers from the lower 48. Everybody has a place to needs to find a place to put their dollar. One of the things that we look at up here in Alaska that makes us attractive versus, let's say,
Anywhere else?
Illinois, California, we don't have a state sales tax here, and we don't have a state income tax here. This is something as every little bit is an expense that comes off the bottom line. We also have large, because of the sometimes barriers to entry up here. You know, if you're going to go through our transportation creates extra costs. So we'll have higher cap rates up here as well.
And a cap rate is really just a measurement of return on your money. So like when you deposit money in the bank, they give you 3% on your savings account or whatever it is. A cap rate is that same mentality on your real estate investment. And cap rates in Alaska are higher because of a perceived greater risk. But depending on the tenant and the real estate, I'm not sure there is a greater risk. If you've got McDonald's on the lease, you got McDonald's on the lease.
You could have a franchisee, let's say, has 100 different sites, and they could have 20, let's say, in Washington, and then they've got 2 up here in Alaska. That 2 in Alaska, it's the same borrower at the end of the day, but they're going to be paying a higher cap rate.
Yeah,
You got the 2. You could be dealing with the same seller. You could be dealing with the same tenant in one state as you are up in, let's say, Washington, as you are in Alaska. You could have a franchisee that has 100 Pizza Huts or 100 Burger Kings. They're going to go through, and when you have a property up here, you're buying a piece of paper. You're buying, you own the real estate.
You're buying an instrument. You're buying a financial instrument. So you're really buying that stream of income that lease produces. And I agree with that. The other thing we have to consider, and we'll help walk you through all of this, is this lender or the tenant may have the same flag on their sign, but it might be a separate LLC for every store. So they could sell that store or close it, and it wouldn't affect this one. So the fact that they have 50 stores is great, but that doesn't really protect you if they want to close one. So there's just a lot of research that has to go into it. But why would you buy in Alaska as opposed to Middle America? The returns are much greater, taxes are much less, and the upside is greater. And I mean, we have all of those numbers. We can back into all of that information. So I think that's a great question. Send us another question that makes us look this way.
Well, and I want to say the other thing on that too is, as you look at the tenants that are up here that you have as a landlord, they have less competition. So they have more of typically let's say a larger market share. Up here we have a Burger King, a McDonald's, a Sonic, but there's a lot of things we don't have. We don't have a Five Guys. We don't have In-N-Out Burger.
We still have room to expand in every every asset class. So fast food restaurants, retail, automotive. I mean, we still have a lot of legs in all of those asset classes. So there's room for us, and there's room to get in on it.
We're still waiting for Trader Joe's.
Yeah, hold your breath. All right.
Barbara, you can send a question to our email at podcast@bhsalaska.com. And we'd love to be able to answer emails, and we'll let you know if we have any interesting comments too. Thank you.
All right. We'll catch up with you next time.